If you're the CFO, the Chief Financial Officer of a company, and you are looking for options to finance the operations of your business, to finance investment in your company, maybe you're entering a new market or expanding into a new product or building a new factory or trying to invest in something that is going to make your business more productive, you really have one of two main options. In the most high-level sense, you can either issue debt to finance those operations or to finance that expansion, or you can have equity financing here. And these two options, really the only differentiator between the two is what are you willing to give up? Are you willing to give up cash flows, or are you willing to give up a portion of the ownership of the business? And let's start with over this in equity financing, where that's really what it is. In exchange for a partial ownership of the business, you would be willing to give up partial ownership in the business to get some sort of cash right now to expand the business. And there's a number of options depending on the size of your company. In the smallest company sense, where you're just trying to work out a prototype, or maybe you've got an idea that you want to take to market, you would really maybe turn to family and friends at the most basic sense, and you might raise $20,000 to $50,000, and you might say to them, "Hey, I'll give you 5% collectively. I'll give you 5% of this company." Because you're not sure if you're going to have cash flows to pay them back, and so you just say, "I'll give you a portion of the ownership, and you're in this with me." As your company grows larger, you have more and more options when it comes to equity financing, but all of these options would come at a cost of some ownership, whether you talk with local individuals who are high net worth individuals that have cash that they can spend and give you money right now for a piece of ownership, or maybe venture capital firms where they've really pooled high net worth individuals, and you might be talking about tens or maybe even hundreds of millions of dollars that would be invested in your corporation or your company. And then in the most basic sense, when we think about equity finance, we typically think about the stock market. You can have an initial public offering, or the stock market itself. Once you're in it, you really have the opportunity to have a number of individuals that have pieces of ownership in that business. And what is it that you really have across all that ownership? Well, you have ownership in the business. You typically have a share of the profits or the earnings. So in this case, that might be a share of profits or earnings. Over here in the stock market, that might be a quarterly dividend or an annual dividend where you get extra earnings. And you might have, depending on the class of stock that you own or the class of equity that you own, you might have some voting rights. You might sit on the board of directors, or you might have some opportunity to have a say in the direction of the corporation. There's about 16 different stock markets now in America, and we have, not to mention across the world, the number of options. And across those stock markets, you are probably most familiar with the NASDAQ and the New York Stock Exchange. But there's a number of opportunities to kind of issue stock and issue equity financing across the market. And so we've really kind of thought about, and I think most people are relatively comfortable with at least the basics of what equity financing looks like. So I want to turn over here for a moment to debt financing for a minute. And if we're thinking about debt financing, the basics here is that instead of giving up partial ownership in the business, as you would with equity financing, when it comes to debt financing, what we're specifically looking at doing is saying, well, in exchange for some cash now, we will pay you interest over a period of time, and then we'll pay you back the amount that you gave us. And the whole point is that as you're financing the operations of the business, presumably the rate of return that you will have on the end result of that investment in the capital, the rate of return will exceed the interest that you had to pay these individuals for the cash up front. So let's just consider this simplest case. Let's say that you're this business and you want to issue bonds at face value. And one of the things that can be difficult about the bond market in general is that not only do we not necessarily have as much kind of familiarity with it in general, but also there's a number of terms that can often mean the same thing or relatively the same thing. So I will try to list some of those as we come across, and here's the first one. So you would issue bonds at face value, and face value is also commonly referred to as the principal. So this is how much an individual would give you, the principal, or it's also sometimes described as the par value. The par value here. And so they are going to give you, an individual would give your business $1,000, let's say, for one single bond. And in exchange, you're going to pay them an interest rate. And this interest rate is also often referred to as a coupon. And it is sometimes referred to as the yield. And I'll be kind of careful with the yield because there's a number of different ways that yield can also be used in the bond market. Sometimes, for example, you could be talking about yield to maturity. So I'll just caution you there, but sometimes these three are used interchangeably. And as a business, you are going to pay, to get that $1,000, you will pay 6% of that $1,000 for a term of 5 years. And this term is also often referred to as the maturity date. It's how long that bond is, it's in essence how long that bond will be in existence, or what day you will be paid back for that $1,000. So let's say that you're the creditor, and again, a creditor is an individual, right? And this is an individual that would loan you money. Loan, we'll say the business money in this case, the business money. And so they're going to loan you $1,000. And I've got that listed out right here. They loan you $1,000 for that single bond. And in return, you are paying them an interest rate of 6% per year. So what is this? Well, this would be 0.066% times $1,000. And you're going to pay them $60 per year for 5 years. And at the end of those 5 years, on the maturity date, you will also pay them the original $1,000 back. And so if we kind of add this up, for three, you are going to spend $300 as a business to get $1,000 today. And again, the goal is that then what you're investing that money in is going to have a bigger return, or is going to increase your profitability or your future cash flows. You don't give up any equity. You don't give up any ownership in the company. What you do have is a contractual agreement to pay out this interest and to repay the face value or the principal of that loan to begin with. This is very similar to like the relationship that you might have with a bank on a mortgage or something of that nature, just in reverse. And so when we think about what's setting some of these things here, well, what I want to first say is that there are other creditor perks. So not only does the creditor get the interest rate and the payment back, but they might also get some tax preference. And the tax preference would be on the interest. So sometimes we treat that interest income in a different class than normal income. And then there are certain types of bonds, and such as municipal bonds, that are oftentimes tax-free. So you don't have to pay federal taxes on the interest income that you would be receiving, nor do you have to pay state or local taxes on it as well. It's a high incentive to purchase that bond. And so who is it that buys bonds? Well, we've kind of got it here. Obviously, we've talked about the corporations, and I just kind of prefaced it here as well. We've got the federal government and the state and city governments as well. The state and city is often referred to as municipal bonds or muni bonds. And what is it that they are what is it that they are funding the operations of? Well, the federal government is often selling bonds. We sell T-bills or treasury notes, and those treasury notes go to pay for a wide variety of things. The federal government has been running a budget deficit for a number of years, and so it borrows money, and it borrows money to finance all the operations, all the spending that the federal government has, from war spending to welfare payments to infrastructure projects. For city and state governments, those tend to be very highly concentrated in infrastructure projects, roads, and things of that nature. But more than that, it is oftentimes, you can think of it as like funding for schools, building schools and things of that nature, building stadiums for a local sports team, and then obviously for corporations as well. And what sets the interest rate or that coupon rate here? If we want to think about that, well, there's many things, but I want to highlight two things here. The first one is the default risk. So if you are a creditor, if you're an individual that is going to loan $1,000 to this operation, whether it's the corporation or the city or the federal government, you are really dependent. So you are saying, I will give you money now, and you are going to give me cash flow over a number of years, and then you're going to pay me that money back at a later period of time. That takes some sort of trust on your end that corporation will not go bankrupt, or that corporation will not go out of existence. In essence, that it will not default. Cities and states can default as well. States are a little bit less likely to because they're backstopped by the federal government, and states are often backstopped by, city governments are often backstopped by their states as well. But we have had a number of city defaults in recent years. Kind of the one that grabbed the most headlines. There's been a number out in California, but the one that, and kind of the South, but one that grabbed the most headlines was Detroit, Michigan, which went bankrupt, and obviously a lot of these bonds were being repaid at a lesser rate as a result of that. So this default risk might increase the interest rate. If you have a higher probability of default, then this interest rate is going to increase. And I've kind of ordered these in default kind of order. The federal government has almost no opportunity to default at all, and that's mostly because there are the federal government has its own money supply, and it has obviously it can continue to tax in the future, and so unless it puts itself into default, which the federal government has tried to do by not raising the debt ceiling at certain times, other than that, really the United States federal government cannot, kind of in our modern economy, default on its loans, and that's why the interest rate might be as low as 1% or fractions of 1%, depending on the maturity date of only maybe a month or 2 or 3. That default risk obviously increases for corporations, and for corporations you really have, and even for cities and states, right, this begins to increase because, as I said, you have some city governments that have defaulted, but corporations as well. And there's really we have the ratings agencies, and the ratings agencies will go through and they try to rate the risk of default. And corporations will have interest rates, and these might vary from as low as maybe 5 or 6% up into the teens, and maybe even the 20%, depending on the likelihood of default. If you are willing to accept more default as a creditor, then you can get a higher return. But obviously the risk of default is that at some point you might get no money at all, and you might not get your initial principal back or your initial face value back as well. It is also dependent on the time horizon. So if you are going to purchase a bond that will be repaid where the maturity date is only 1 month from today, it is relatively unlikely that conditions will change dramatically in the next 30 days, and so you might have a lower interest rate as a result. However, as the time horizon expands, there is a number of things that can happen, both kind of macroeconomically across the economy or for that corporation. If you think for the corporation itself, right, you could have new competitors that come into the space, or you could have new opportunities that present itself, or you could just have bad decisions. You could have individuals who run the company that make decisions that don't actually put the corporation on good terms. And so as the time horizon increases, we generally think that the interest rate increases as well. These are some of the types of things that we consider when we think about the bond market and kind of the stock market in the most general sense, and even more general, the equity market and the debt market for financing business operations.